Hey everyone, welcome back to Tubeshaala, where we simplify the world of finance, accounting, and data one concept at a time. Hi, I am Dr. Abhijeet Chatterjee, and today we are going to decode one of the most important and talked about terms in the financial world, that is EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Sound complex, isn't it? So let's simplify. EBITDA tells us how much profit a company makes from its core business operations before accounting for financing cost, taxes, and non-cash expenses like depreciation and amortization. There are two main ways to calculate EBITDA. EBITDA can be calculated by adding net profit plus interest plus taxes plus depreciation and the amount of amortization. Another way of calculating EBITDA is EBITDA is equal to operating revenue minus operating expenses. Both the methods of calculation EBITDA shows that how efficiently the company's main business is performing without being affected by its financing or accounting decisions. Let us take an example. Suppose ABC Limited reports a net profit of rupees 100 crores, interest of rupees 20 crores, taxes worth 30 crores, depreciation of rupees 25 crores, and amortization being rupees 5 crores. Now, applying the formula of EBITDA and adding all these figures together, we get EBITDA is equal to rupees 180 crores. It means ABC Limited generated rupees 180 crores from its main business from before paying interest, taxes, or actually for accounting for non-cash costs. Now let's compare two companies, Company X and Company Y, both reporting rupees 100 crores of net profit. But Company X is having heavy loans and higher interest cost, while Company Y has less debts. When we calculate EBITDA, we might find Company X actually earns more from operations. That means EBITDA gives us a clearer picture of company's true operational strength. So, why is EBITDA so important? Because it helps investors and analysts see the company's core operating performance, how much cash it can generate from day-to-day business. It is also useful when comparing companies across industries or countries with different tax and debt structures. But remember, EBITDA isn't perfect. It does not include interest, tax, or capital expenses, all of which are actually real costs. So, a company may show high EBITDA but still struggle with debt or poor cash flow. That's why smart investors use EBITDA alongside net profit and cash flow analysis and never alone. Let's quickly recap. EBITDA is equal to earning before interest, taxes, depreciation, and amortization, which is showing the operational efficiency and cash generating ability of a particular company. It helps compare companies fairly but doesn't tell the full story about debt or real cash flow. So, next time you see a company flaunting its EBITDA growth, you know exactly what it means. If you found this video helpful, hit that like button, share it with your friends, and don't forget to subscribe to Tubeshaala for more simple, smart, and practical lessons on finance, Excel, and business insights. This is Dr. Abhijeet Chatterjee signing off. See you in the next video. Until then, keep learning, keep growing with Tubeshaala.